my what I call my 2022 outlook. And in that, I raised my equity market targets. I had been at 5,300 for the S&P, 18,000 for the Nasdaq. Let's see, 42,000 for the Dow, and 2,900 for the Russell 2000. And those were all aggressive targets that most people questioned, and people were getting more, coming closer to them, but I was pretty much the high on the street. And I did my work at the end of the year, and the more I looked, the more I said those targets are just not high enough. When I say melt up, people quote the term melt up a lot, but very few people really understand the concept of a melt up. We've only had a few of them in history in the equity markets. 1929, maybe the Nifty 50 in 1973, certainly the Nasdaq in 2000, but not very many others. It's not just a big rally; it is something really to behold. And when I took a look at a lot of cross markets and a lot of underlying stuff in the equity markets, I came away saying I'm just not. My targets are not aggressive enough. I raised my targets in this letter that came out last week to S&P 6,000, Nasdaq 20,000, Dow Jones Industrial Average 45,000, and the Russell 3,000. Now, those may sound insane. In most cases, I think they're 30 to 40% away from where we're at. And I'm also saying we could get there in 3 to 6 months' time, depending on when it gets started and how fast it really gets going. But parabolic melt up is really what I'm talking. And parabolic, we've had, when you step away and look at a longer chart, we've had a parabolic melt up since March 2020. But the last stage is going to be the steepest of all. So it's going to be almost a vertical move where momentum begets more momentum. People feel the train's leaving the station and have to get on. And it's not going to come just from psychology, although that plays a big role. It's also going to be a very viable argument. People are going to look and have, for one reason or another, going to have confidence that this thing has legs and could go on for years. It's not going to be somebody jumping in because they think the next 2 or 3 months is good. This is going to be people across the spectrum, institutional investors and retail investors, getting very bullish for reasons that I can guess at. I obviously don't know. If I were picking, if I were guessing, I would say the likelihood is that the tightening that's going on, we're all, and this has been going on for many months, everybody's been speculating about Fed tightening. And when Powell had his spoke in late November and early December, he basically capitulated and said, this inflation has legs. It's not just transitory, and we have to deal with it. We need to nip it in the bud. We're gonna speed up our taper, and we're probably gonna tighten in 2022. That was a big change, and that began the move in interest rates, where you've seen the 10-year go from 135 to 180 basically, and I think it's on its way to 210 before it pauses. That's a big move in a short time. And what I learned way back in the 1980s is the power of the bond market, or what we used to call the bond vigilantes, in terms of them doing the tightening and not needing the Fed. If the rates are being pushed higher by the bond market, the tightening is already happening. Everybody's focused on when's the Fed going to hike rates? When's how many rate hikes are we going to see in 2022? To me, that's not the important thing. It's all happening right in front of you. It's happening. The tightening is already occurring, and I think the likelihood is that as we move through the first quarter, the narrative is going to shift from the Fed's going to hike 3 times or 4 times. The narrative is going to shift to maybe the Fed's not going to hike, and the reality is that the rate move will have already taken place, And if that's the shift, all of a sudden you've gotten out of the way something that's been in the way for most of the last certainly 6 or 9 months of everybody fearful of when's the cycle going to end? When's the Fed going to start tightening? I was one of the earliest ones talking about Fed policy mistake that would lead to a bust. And now everybody's worried about that. So I think if the reality is, or the narrative shifts from Fed tightening is just around the corner to, hey, the tightening's already occurred, you're going to have the wind at your back again. And I think coinciding with that very well could be um, a sense that, and again, I'm talking about narrative, not necessarily reality, but a sense that for at least the next several months, that the worst of COVID is behind us, that Omicron is kind of the weakening variant that you see as a virus starts to dissipate, and that we've learned to deal with that, and you get away from this constant counting of constant testing and counting of cases and hospitalization, and that it starts to feel like normalcy is creeping back into our society, into our economies around not just in the US, but around the world. If there's a feeling that COVID's being put behind us, that will be a huge wind at the back of the markets. So I think it's a combination of, maybe the narrative changing on Fed tightening and narrative moving towards COVID is no longer, going to shut us down. Those two things may be the impetus for the melt up. Could I be wrong? Maybe it's something else, possibly. But my work, just when I look across the board, it just says, yes, we got to get this correction out of the way. But once it's correction out of the way, there's another leg up that's going to be the biggest leg yet.